Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Good afternoon, 7 investors, and welcome to the Friday edition of 7 Investing Now. My name, if you've forgotten, is Daniel Brooks Klein. I hosted 150 of these shows in a row. And then last week, due to nothing but pilot error on my part, Simon Erickson stepped in, and I realized I had to come back because I liked both of those shows. And you do not want to leave for too long when someone could step in and do a great job. I participated in one of them. It was a lot of fun. We are going to have a packed show today. I know we say that all the time, but I have Steve Simonton, Max Chatsko, Simon Erickson, and Matt Cochran. Dana Abramovitz has another obligation, and Anirban Mahante is either punching with a kangaroo or sleeping. It's one of those two things, because he, of course, is in Sydney, Australia, where the time is very different.
Can he be doing both, Dan? Can he be punching a kangaroo and sleeping at the same time?
Anirban is very impressive. I can picture him doing that while also hosting a podcast. Like, that could be happening. We are going to talk about our investing process, how we identify winners. But before we do that, we always start this show with something a little bit fun. I wanted to be a little bit more serious about our fun because I think I've exhausted all the silly questions. But as some of you know, I just got back from a trip. So I wanted to ask everyone, what stock do they own that brings them the most joy as an investor, meaning they like what the company is doing, and as a person, meaning they like the product? And I'm going to go first because I'm not sure how much prep time everybody had because we just did our members only call. If you are not a member, the members only call is worth the price of admission alone. But I'm going to say, for me, it's Royal Caribbean. That is a stock I really like because as I've watched them get through the pandemic and open up new ports, they've purchased some land in different places. They've done some really smart things that are going to advance their business. They've used the lower capacity during the pandemic to try out some new things and figure out some experiences that are going to do really well. So that is a business I really, really like. And as a customer, there is nothing more joyful than going away for 4 or 5 days, stopping on a couple of islands, meeting new friends. So that is a company that brings me joy as a business and joy in my personal life. I will throw it to Steve. We will go around the room in order.
Oh, man. I'd say it's a toss-up between iRobot, which I would love my Roomba. I love our Brava, right, for cleaning the floors. Haven't vacuumed our floors in like a decade. Also own the stock for more than that. Or maybe if we're throwing out a bonus pick, my not Apple, but Universal Display, OLED is the ticker, right? This is an OLED display on my phone, and I mean, yeah, I mean, you got to give him credit for that. So that's another stock.
I like the fact that it's not Apple who put the whole phone together; it's just the display,
just the display, and plus the fact that I've had that stock in my portfolio for more than 10 years, and it's done quite well. So yeah, I'd say those are my top two.
I'm curious, Max Chatsko, if you have an answer here, because you play in a space that if you haven't been afflicted by certain things, you're not getting a lot of joy out of biotech companies. But of course, your investments are not limited to that area. So if you don't have an answer, that's great. But if you do, I would like to hear it now.
Yeah, really. I mean, there's not many things that bring me joy in life, Dan. So that's the reason that I can't answer this question. No, thankfully, I don't have to take any of the products from my companies that I own in terms of drug developers. I own some energy companies, some utilities and things. I'm thankful for electricity and light bulbs, all that good stuff. I actually did start a position in one of your recent recommendations in the cannabis space. Haven't used their products yet, but interested in that whenever I get to a city or town where they are at. So.
Sure you haven't. Simon Erickson, as far as you know as the boss, Max has absolutely not used any of those products. Simon.
I think we need to expose Dan to you as often as possible, Dan. If he's not getting too many things that bring him joy in life, we just need to put him with you on the show more often.
That particular company could bring you.
I got to go with Chipotle. I love eating there every time. It's even more fun when you go with your kids because then you get to see how much they love it. So that's my pick. CMG.
Chipotle is weirdly universal. My son loves it too. Matt Cochran, what is it for you?
Probably Amazon. I don't have to leave the house. I can just order things. That works for me.
Matt ordering nothing but Snuggies from Amazon. We're going to move on to our top story today. And Here's the idea. We're going to talk about how do you identify winning stocks. Well, what's the logic here? There's no one process to do it. Someone during our members only call today asked about a company that Simon knew I'd been researching. And part of the reason I haven't added it to my portfolio or made it a pick, both are things which could happen in the future, is because I haven't physically visited the company. Now, that's a part of my process. It's not a make or break, but it's something I definitely like to do. And that might not be important to anyone else on the team. So we're going to ask everybody and go through a small group of questions. And of course, if you're watching, we are happy to take your questions. Or if you have some market questions, we know it's a Friday. We know you're all tired, but we are always happy to take your questions. So let me start with, how does a company get on your radar? And for me, it's really easy. It's often just something I do when I'm sitting there and I go like, hey, is this public? We'll go in reverse order and start with Matt here.
All right. So the first thing I do to research a company, is that
how does it get on your radar? Do you drive by it? Are you just looking for, obscure news stories? Like I know, like in Max's space, maybe Biopharma Dive might do an article in tech, maybe GeekWire will have an early article on something that, might be public or a public company you weren't aware of. Sort of how does it start for you?
Sure. Like, I guess I don't know if I have a set answer for that. I feel like investing can be a game of he who turns over the most rocks wins, kind of deal. So I'll look for ideas anywhere. That can be stuff I use in my professional life or personal life, or it can be like because one of you recommend a stock for a report. It can be something like I see on Twitter. I'm always looking for new ideas. So I don't want to limit that to I don't want to limit that discovery process to just a few ways. I want to have as wide of a funnel as possible, and then filter the companies down from there. So any way I can come across a company, when you find out where people work, you say, oh, where do you work? And, how do you like it there? And, anyway, I think you can discover a company, have as wide of a funnel as possible is good.
This is why we're discussing this. Everyone's process is different. Simon, you are up next.
That's totally the key, is that there's no right answer to this, right? It's such a subjective question that everyone will be different depending on what kind of investor they are. For me, I always try to stay at least a couple of steps ahead of the rest of the market. I think that one of the biggest advantages we have as individual investors is we don't have those same self-imposed rules that institutions do. Funds say, oh, it has to be a certain market cap, or oh, it's got to be a certain sector, or whatever else it is. That so many tens of billions of dollars are going into. We have the opportunity to look where people are not looking. And so I tend to try to look for what is something new that isn't being talked about enough yet, but it is starting to get attention of the techies and, of the PhDs and the conferences and the things that people are really excited about that are kind of pushing the limits of the space itself. I think of myself as a top-down investor where I look at the market first. And so when we hear about things, the last couple of years, we've heard about buy now, pay later. Now we're starting to see investable options from that. We've heard about gene editing. We've heard about investing options from that. We've heard about ad tech platforms. We're starting to see options from that. It just continues to evolve, right? Max knows that in the healthcare industry, we're starting to talk about things like DNA synthesis and spatial biology and kind of these things that are interesting, but maybe not yet investable. But I think that as individual investors, I always like to keep in touch with what's going on out there.
The process often starts well before you can actually invest. Max Chatsko, that's certainly true in your space. A lot of times it is a theoretical idea even before it's an investable company.
Yeah, so I take a bottom-up approach to investing. So I start off with some interesting tool or technology. Sometimes it's just emerging in academia. So I read up on that. And I try to understand all the challenges and opportunities of implementing those tools or implementing those processes. And, it usually takes some time and some years, but eventually there's spin outs from, academic labs, and those become startups. And maybe eventually, years later, they become publicly traded, or those startups maybe have a collaboration with a publicly traded company. You start to see some interest in those spaces and tools and processes and so forth. So it usually takes some time, but I try to, again, cast a wide net, focus on the technologies, and then I look at the competitive landscape and see what companies are there. One really great place to look for me is medical conferences. Lately, that's been, from the comfort of my own home and office here, in recent years. But you go and you see companies or scientists present, and then you see what company they're representing. And sometimes you're like, I've never heard of this company, and it's a startup. But we've seen a record number of IPOs last year. It looks like we're going to pass that here in 2021 for biotech and drug development. So things are really getting quite interesting. So lots of different ways to find and discover new companies.
There is nothing worse than a virtual conference. I appreciate everyone for trying, but boy, do I love being in person and getting to interact. Now, 1 hour, one seminar, a keynote or something. But Simon, I know you're going to one next week, a tech conference. We could talk about that a little bit later. But I just find this is one area where in the pandemic, nobody has figured that out. Apologies to the folks at Zoom or other virtual platforms. Steve, how does it work for you? You live in an area where you probably actually own a big net, but that is not, or a wide net. That is probably not how you cast your net. That is probably just for salmon fishing or other things you could be doing.
Yeah, it's funny because I'll travel and people will be like, "Oh, you're from Montana? Do you have internet? Do you have cars and laundry machine?" I'm like, "Come on!"
The answer is no.
Yeah, I was working on machine learning technology 15 years ago here, but I take more of a top-down approach, to my investment kind of radar, right? I'm looking at kind of bigger picture factors. I'm looking at enormous industries that are maybe ripe for disruption, and finding the companies that are trying to do that, or maybe emerging industries with the few early leaders in those spaces. So yeah, I kind of do that. But I think maybe more important is something Matt kind of touched on, even though some of my recommendations can make Matt a little squeamish, right, with their risk profiles. But he was talking about he who turns over the most rocks, right? I spend a disproportionate amount of time reading all day, every day, at night, and just reading, researching, turning over rocks, and sometimes these companies that you've never heard of kind of pop up onto your radar, and you say, "Oh, that's publicly traded," or "This is a really interesting business that's growing, compelling software as a service revenue stream, recurring revenue, juicy gross margins." Sometimes they pop onto your radar, and it's a matter of just constant research. Hundreds and hundreds of hours sometimes before you really feel comfortable actually stepping into a business. And we have the luxury, thankfully, of being able to do that. As kind of professional investors, we sit home and I read a lot of the day when I'm not responding to member emails. And so that's just part of it. It's just the sheer time and effort involved.
Steve, that segs into the next question here, and we'll go back around the horn in the other direction. And it's when you decide to look at a company, what do you do first? For me, if I haven't already done this and it's a place I can visit or a product I can hold, I want to hold the product. Because let's pretend you'd never heard of Apple and someone says, "Geez, that's a great investment." Well, you go out and get an iPhone, and let's pretend the iPhone works like a Palm Pilot from 1985. You're going to go like, "Ooh, that's not good. I've used an Android." Now, that's of course not true. I'm giving a silly example. But if you don't like the end product, it's really hard to make a case for investment. And I know people do, but to me, if what they're doing isn't well executed. Now, are there companies that need smoothing out in the execution? Sure. Anyone who isn't Starbucks or Domino's needs to figure out delivery better, and they'll probably get there. We're seeing it at every retailer in terms of automated checkout. But the core product is still good. Steve, is there a document for you? Is there one particular thing you go to first?
Sometimes that's kind of hard, especially with enterprise software companies or something. Some of my favorite investments and best performing investments, you can't really hold their product, right, when it's not a tangible physical thing. But first thing I'll generally do is just hop on their investor relations page. I'll find a recent investor presentation, but I'll also take that presentation with a grain of salt, right? They are trying to convince you to invest in their company. And, a lot of times these kind of polished investor presentations gloss over some of the more concerning risks involved with these companies. So then you go dig into some of their SEC filings and their latest annual filings, assuming they're available, and look at the nitty gritty parts after you've kind of looked at their big picture investment thesis. Dig into the details, right? That's where the devil's in the details, and figure out What are any red flags, potential risks with their product, competitors, like those sorts of things. So, but yeah, a great place to start is just to check out an investor presentation, just to figure out the absolute bull case before you kind of dive into something that might deter you.
Steve, we are not as young as we once were, so please take that with a low sodium grain of salt. That would that's a lot of grains of salt we'd be taking, because one of the things you see when you read company delivered research or company delivered earnings reports or whatever it is they're going to find a way to shade it well. And I can promise you that. Go back and read any Sears earnings call, and you would think this is the most thriving, successful company that just had a little bit of a quarter. I like to read bear reports after I do. I want to see the person that hates this company. What do they have to say? And if I find what they have to say like pretty fanciful or stupid, and stupid is an unfair word. Not something, a credible case in my opinion, then that's going to make me feel much better about it. Max, I assume you can't go out and test the products for most of your companies.
No, I cannot. So this is great, though. All the questions that we're going to go through today actually walk through exactly how I identify companies. So we're going to build a cake, guys. You ready? I actually don't know how to bake a cake, but so we start off right bottom up.
Yeah, you don't build a cake. You bake a cake.
I'll build it. I'll bake it. I'll do whatever please. All right. So we start off with bottom up approach. Scientific literature. You read that. Importantly, you're being objective, right? And that's really what scientific literature is about. So you're understanding the challenges and the opportunities. From there, the next layer up, I then look at the landscape. So that's where companies come into focus. So I look at who's doing what, how do they fit in within these tools and technologies. And specifically, I'm looking for companies that have technology platforms, because it's easier to recover from failure. It's easier to scale that. I'm looking for companies that have durable advantages, makes them easier to navigate the competitive landscape. Maybe they can displace some incumbents. I'm also looking for companies that are addressing pain points. Very important in science and technology. And sometimes, more often than you think, this actually bleeds into publicly traded companies. They are companies that have solutions looking for problems. You do not want to invest in those companies. You want companies that are actually building solutions to problems. So addressing pain points, something that's maybe harder to tease out if you're not really following specific, parts of a field, or what's holding back gene therapy. Where might gene editing go off the rails? What companies are doing things to address that? So I look for companies that are doing those three things.
Simon, later in the show, we will talk about making a Red Sox Astros bet. But before we do that, what is the first thing you do when you look at a company?
Yeah, so I like what Steve said. Go to the investor presentation first and figure out how that company's making its money. And of course, it's going to be biased. They're trying to get investors on board, so they're going to brag and be very proud about it. But you should be paying attention to what is this company doing differently? What do they want you to know? And Steve also said, if they're disruptive, that's another important word too, is it's very hard for a newcomer in these large industries to do exactly the same thing that the largest incumbent players are already doing. If they're playing the same game, if I'm going to go out and try to compete against Apple, or Micron or Intel tomorrow, there's no way I'm going to build a fab in my garage that can do that. There are some things that companies that are new, that are ahead of the curve, are doing differently, that we need to figure out what that is. And so what I tend to do is, in addition to the investor presentations, which is fantastic, like Steve said, I'll go back through and I'll watch TED Talks, I'll watch YouTube videos, and I have kind of this catalog of 4 years of investor conferences that I've gone to, that I'll just go back and I'll say, okay, was this mentioned before? Was this technology mentioned before? Is this approach any different than what was being done before? Let's look at it kind of from the early adopters and what they're excited about, and see if there's a company that fits the most realistic or efficient approach to tackling this problem. And then kind of the next step is like, okay, what's the company that's doing that, that has done it really, really well and has grown their revenue and grown their business around that? CrowdStrike is a perfect example of what did this in cybersecurity. It's a completely different approach to what the rest of the industry was doing.
Yeah, and that can be tricky to identify. And that goes back to what Steve said. We all spend an enormous amount of time going through these companies. The one someone mentioned on the members call to me, I probably spent 7-8 hours just reading, and there wasn't even that much. It's a new company. It doesn't have all that. It's not a new company. It's a newly public company. It doesn't have all that much data. So you got to look around and read like magazine stories from that industry, interviews with the CEO. I will say that's one area to be careful. And we're going to get to Matt and then to Max Lucas's questions in a minute. Beware the charismatic CEO. I'm not saying you don't want a company that has a charismatic CEO. That can be wonderful, and it could be really good for your brand. But if someone is charismatic, but the business isn't good, the charisma can cover that up. So you want to be really, really careful about that. It doesn't happen that often. An example I'll say of someone who's an excellent CEO is actually not even the CEO, the guy who founded Beyond Meat, which is not a company I believe in, but is one that has done very, very, very well. He could convince anyone, the most ardent person sitting in a steakhouse, he could convince them that that's a great product. You've got to look at the numbers. You got to look at the business. Matt Cochran, what is the first thing you do?
It kind of depends how I found out about the company. So, like, I mean, if I'm listening to a pitch from one of you guys, and you guys already wrote your report or something, like the first thing I'm going to do is read your report. Same if like somebody sends me an analyst note or something like the first thing I'm going to do is read that. If somebody sends me a ticker or a company that I don't know anything about, like the very, very first thing I do is plug it into like Y chart or ticker and just look at like a few numbers really quick. When I don't know anything about the company, though, like pretty shortly after that, I'm going to open up the 10K and read the business section. And that used to really intimidate me when people talked about that. Like, you should read the SEC filings or read a 10K. I thought it was going to be a bunch of gobbledygook and I wouldn't understand any of it. But the business section at the beginning of any 10K, where they describe their businesses and what they sell and how they sell it and, like their competitors and things like that, can be immensely valuable. So that's the real like if I look real quick at the numbers and they interest me at all, or if I read a report that interests me at all, like, and I want to find out more about the business, the first real thing I'm going to do is go to their investor relations website and open up the 10K and read that business section.
We're going to get to Max Lucas's question momentarily. Matt, everyone, thank you for that. But Simon, before we do that, we probably glossed over the obvious here. This is the promotional part of the show. But the thing we all missed is we all read each other's reports and watch each other's presentations. We have to watch the presentations, but I think we would all also choose to watch those presentations, because honestly, the vast majority of my investments are stocks you guys have recommended. And I am lucky, and I don't know if you give access to the whole team, so I am lucky to have access to the 7 Investing team. I get a free account as someone who works here, and I can look at, I'm teasing, of course we all have access. I can read in depth, and I also can talk to Steve. Well, you know what you can do? You can talk to Steve too. If you came to our members call at 11 o'clock today, you could have asked questions, and people ask questions about some of our picks. They also ask questions about some things we've all been thinking about, and we tend to know what everyone else is working on, at least some of it. So we're like, oh, Steve will take that, Simon will take that. And there were some suggestions that I jotted down, and I'm sure everyone did, and I went, ooh, that's one I've kind of been on the periphery of. Maybe I'll take a quick look at it. So Simon, if someone becomes a 7 Investing member, in addition to our picks, to the massive 3,000 plus word write-ups with graphics and animations and fireworks. I don't know, there's a lot of stuff in our recommendations, as well as our video deep dives, which are basically fancy PowerPoint presentations where not only do we present the bull case, but we can ask the questions. So I could present a company, and Matt knows my space, and he could say, wait, what about this? What about this competitor? Geesh, I don't like that their CFO when he worked here. We have to answer those questions. So Simon, what else do you get as a member of 7 Investing, and how do people join other than driving to my house and dropping some money in my mailbox? I don't actually have a mailbox, so that's a pretty safe joke to make.
Yeah, it's fantastic points that you made, Dan, that, 7 Investing at the bigger picture, what we're really trying to accomplish out there is empowering people to make better decisions, because we know that investing is very personal, and it's very difficult to say, for me to tell Steve what the best pick is for Steve, or to tell Max what the best pick is for Max. We want to create a service that shares information, that we've done a lot of our homework and we've shared that out there, but then we leave it up to everyone to pass the torch to them and say, what's the best pick for you? And so just like you said, I think that it's enormously beneficial, the access that you have to the team. One of the best ways is emailing us, info@7investing.com, or even on Twitter @7investing. I mean, if you're a member and you say, hey, full disclosure, I'm a member, I have a question about one of your recommendations. What do you think about this? And you send an email, Steve sends those around to every one of us and say, hey, what do we think, team? Here's one of our subscribers that wants to hear our thoughts on things like this. You don't get that kind of level of access to a team that's running an ETF. You rarely get access to that kind of a team that's running a mutual fund where you're putting your money into something and then just letting it ride. I think that 7 Investing is more of the teaching a man to fish approach, where we're really trying to empower people. We're really trying to show everyone what we look at. And of course, we have a diversity of opinions on this team, Dan. It's been neat. Some of the stocks that we talked about recently have had perspectives from retail and fintech and AI. And, maybe Max biotech's a little different for a lot of them, but, there's different pools that we can play and share ideas and share that with our subscribers. I really love what we're building here.
Yeah. And if you'd like to become a member, it is 7investing.com/subscribe. It is $49 a month, but more importantly, you can join annually for $399. I almost got that price wrong. For $399 a year. And if you are a student, we offer an $84 student membership. If you have trouble getting that to go through, if you have a .edu address, it should work fine.
Per year, Dan, $84 per year. We should
$84 per year. Yes, it is not a more expensive membership. It is a cheaper membership. And part of that is we really get excited about the next generation of investors. I know that 4 of the 5 of us on here today have kids of varying ages. And investing is something that, look, I was a little late to the game. My son's account is only a couple of months old. When he started working, I made him open an account and some of his paycheck goes into that. But I'm really excited to talk to teen groups and college groups and sort of share, do this in your teens. Oh my God, you're going to be rich by 50. Like, things can go. You truly can get rich slowly. And look, we are selling expertise. We are selling the homework we do. We are not, the flashy receiver who catches the 110-yard ball. Hey, that happens sometimes, But for the most part, we are the grind it out and do your work team. And there is not a better team in the business. Legally, Simon can't say that. I can say that. I have been around a lot of teams. I have never worked with this level of expertise. I have never worked with people that make me want to be better and make me better every day. Back to the program. We're going to take a couple of questions from Max Lucas here, a friend of the program. Max says, and if you want to pull that up, JT, do you guys ever own companies you don't care about the product? I own a cannabis REIT, even though I have no interest in cannabis as a product, but I believe the sector will grow. And his second part of his question is, on the same note, I love traveling and travel, but I'd never own an airline. Yeah, I am very wary of travel companies for the most part, even though I do love to travel. I have 1 or 2 in my portfolio. I have 2 actually in my portfolio, one that has been a pick. But yeah, just because you love something doesn't make it investable. And I think we've actually seen that in the cannabis space quite a bit. There are a lot of people who maybe love their cannabis and thought that made it a potentially bigger thing. I think we're seeing a very similar phenomenon in sports betting. But Steve, do you invest in things that you don't like?
I wouldn't say things that I actively dislike, but yeah, I would say that I've invested in things and hold investments in companies with products I don't particularly personally care about. Right? Take Nutanix for instance. Right, they're hyper-converged infrastructure company, and they focus on kind of back-end internet stuff, converging your compute, storage, and network infrastructure into one. Don't particularly care about that personally, but it's a fantastic business, and they're building kind of fantastic recurring revenue streams, and I love companies like that. But yeah, absolutely. I'm always easy to find that. It's not so much a Lynch invest in what kind of thing all the time. I don't subscribe to that exclusively, and I don't think anyone should.
And I'll take hand raises for who else wants to weigh in here, but I'll say secondhand knowledge to me is important. Like, I'm not a great basketball player, but if I'm sitting next to someone who is, they can have an opinion on, a basketball investment. So I'm pretty sure, like, if you want to invest in a cannabis REIT, you probably know someone who knows that space really well. And some things like real estate and property, like from a REIT point of view, there are some really good companies I like. I can't say I care about their business, but I'm absolutely interested in whether it's a Simon Property Group or an American Tower. Those are companies that are on my research. Neither one is personally a holding. Simon, you want to close out this topic here before we move on?
No, I think those are all good points. I mean, there's a lot of high-profile companies like Facebook You kind of got people who love it, people who don't love it, but you can't, or at least most investors wouldn't argue that it's out there. It's got billions of users. It's got network effects. I mean, stuff like that. It's polarizing. The whole market is polarizing. We're looking to go out and look at his investments as ways to provide returns. I don't necessarily think you have to love the product or love even the management team to find a good investment and actually put money to work into it.
And some I struggle with. Facebook is a great example. Product I use every day that I don't own, but I see how good an investment it is and how it should be, or like there's a lot of them like that. And I know some people are completely agnostic about it. Like if it's going to make me money, I want it. Whereas I'm somewhere in the middle and some are absolutely the opposite. So it's really about your personal style. Let's get back to the topic at hand. How do we identify investments here? We have just a few more questions. How important is management to you? To me, management is the be all end all. I want to not only love the CEO, I want to see a deep bench. I am very wary of a company where if I ask the question, who is the next CEO? There isn't either a very clear answer or 4 people, like a Disney always has like 10 people that you could go, that is a contender. Now, the problem is when that's the case, when someone gets the job, half the rest of those people leave. So that can be a negative as well. But to me, management is really, really important, which I'm sure Simon is going to like because I work for Simon. So, when you feel management is important, that is big. But Matt, your question, up to you here. How important is management to you?
Yeah, it's important. I wouldn't say it's the be all end all. Like I want a competent management team and I want an honest management team. I want a management team that communicates clearly, but that's, I guess those are the 3 things I'm looking for. Like after that, like I'm much more interested in the business model and the company, like what they do and the products, if they have an economic moat, things like that, I think are more important than the management team. As long as they're competent, as long as they're honest, I'm good. I'm good with management.
Simon, your thoughts on this one here?
Yeah, I take both approaches for this, Dan. I mean, sometimes it's super important, sometimes it's not important. There have been times. Let me give an example to bring this concrete. Right, a couple of years ago was at a fintech conference, and they were talking about kind of the precursor to buy now, pay later. At the time, they were talking about transparency in finance, but it kind of has turned into BNPL today. But this was years ago, and one of the speakers that was really, really pushing for this was Max Levchin. But he kind of the guy that came from PayPal, CTO of PayPal, really, really wanted more transparency in the financial industry. Goes on and really backs the idea of Affirm, the company that today is now kind of one of the poster children of buy now, pay later. And he said after a little while, I don't want to just be a backer of this company. I think I should be the CEO. And of course, everybody is ecstatic about Max Levchin coming in and taking the reins of this company that's now just done fantastically well in the stock market. So started at the high level, we saw the industry that needed to change. We saw a company that was founded to make that change. And then like Matt and you were talking about earlier, Dan, I mean, there are aspects for a firm that touch the retail industry, which you follow so closely, that touch the financial technology industry, which, Matt is all over on top of. And then there's also a huge computer science component of this too, that Steve is really on top of. It's interesting to see things and opportunities like this come together. I think that in that case, I was so excited about Firm because of the leadership of Max Levchin.
And travel and healthcare as well, which are new. Like I actually had a very small bill for a trip like a year from now. It was like $84 and Affirm popped up. Do you want to? And I'm like, I just want to see how this works. So I'm paying like $6 a month. But what a great way for people to be able to pay for things that they really want to do. Or I'm dealing with, and I'm leaving after the show, my cat may need surgery today. And while I could pay for it, it is really nice to be able to say, "Ooh, I'll spread that really unexpected expense out." Though, boy, there is a Simon pick that I wish I had paid more attention to back in the day. If you're a member, you will know what I am talking about. Max, your thoughts on this one. And Karen, I see your question. I promise we will get there.
Yeah, quickly, I just want to point out, there have been 3 Maxes referenced on today's episode. I think that's a record. So we should all band together and like start a cult or something. Max Lucas, DM me later. We'll talk about that after the show. How important is management for me? Management's important for any business you own. But in pre-commercial drug development, the science is really what rules the day. It doesn't matter if you brought back Leonardo da Vinci, installed him as CEO, if your clinical trials aren't going to be successful, if you have a bad development strategy, right? Now, good management can help companies to navigate development risks or regulatory risks or commercial risks. But at the end of the day, it's really all about the science. So when I'm evaluating companies, management's a box that I check. Bad management always counts against the companies I'm looking at. Good management, all right, I check that box. Of course, I want there to be good management, but it's really not a primary focus for pre-commercial drug developers.
Apologies for the spoiler for those of you who did not know that Leonardo da Vinci had died. But yes, he has not been with us for quite a while. Steve, I'll give you the last word on this one. Then we will take Karen's comment. Then we will move into one more question on this area. This has been illuminating. And the reason we're doing this, again, is 7 people, all friends, all work at the same company, all approach things sometimes a little differently, sometimes a lot differently. Steve, how does this factor in for you?
Management, right? So it's important, but I agree with some of the other sentiment that we've voiced here, that it's not the be all end all, right? The first thing that comes to mind is the old Warren Buffett comment that you should invest in businesses that could be run by an idiot because eventually someone will, something to that effect. I'm paraphrasing. I also think that kind of does that comment, that observation from him takes away from how important good management at the helm actually is. So I think it's more important than that Warren Buffett comment kind of implies with a lot of the businesses that we tend to recommend. But yeah, I think if they're a competent, honest management team, I'm going to have to be able to trust them to invest in the company. But it's one of several check boxes, like Max mentioned.
Yeah, incompetence is definitely something you don't want, and
dishonesty, right?
Yeah, dishonesty is really, it's all the things you wouldn't want in a friend are also important things to look for when it is a company. And of course, since we've had Max Lucas, Max Levskin, and Matt Schatzko, a shout out to Max Headroom, Cinemax, and of course, the most important Max in our lives, HBO Max, home of Titans, which I have been watching, and I'm about to watch Doom Patrol, which is in that same universe. And there is Peacemaker, which is a spin-off of Suicide Squad, which is actually a better movie than it got credit for. We're gonna take Karen's comment, but we're not gonna put it on the screen just because there's something in it that's not a big secret, but it's something we haven't gone fully public with yet. But it is something that, if you're a member, makes our service even cooler, and it will be public relatively soon. But Karen says, if you commit daily 1/2 to 1 hour of focused investing / financial time, not double or triple tasking, like listening while working on a farm. Wow, working on a farm is very specific. What should a new 7 investor read or do with the site and all of the amazing company information to get going buying stocks? I would say, of course, read everything I've written, but that is very biased. So I will go to Simon, who has sort of put our content strategy together and probably has a better idea on this than I do.
Yeah. Okay. So half an hour to an hour a day, and you really want to focus in. If you are a subscriber, I would recommend reading a couple recommendation reports. Go to the top of our site, 7investing.com/recommendations. We come up with 7 every month. Pick 2 or 3 that you can probably get through in an hour. Maybe some of the biotech ones will take you a little longer than some of the other reports. But I mean, that's the most detailed. That's actually great if you're spending an hour on the site every day. That's fantastic. Go through a couple reports and you'll see what we're seeing. If you have less time than that, if you have 20 or 30 minutes even, I would recommend listening to our podcast, which of course we publish, Dan, our live stream to our podcast every day as well. And, if you've got even more time than that, if you want to spend some good bedtime reading on the site, I would go through the company updates where we really get into the nitty gritty of what's going on with our previous recommendations.
Yeah, and one of the things that's really important is we give you lots of different ways to get into our content. So you could go to our recommendations page as a member and just flat out see the list of recommendations. That's useful. Or you could listen to this show, or you could listen to a replay of our members call. You could read the recommendations, but you could also, after this show, I'm going to take this and I'm going to cut this up into 4 or 5 different pieces. So if you don't feel like reading the transcript or listening to a 10-minute section, you can just read the 600-word intro I write. That'll give you the overview of what we said. We try to make it so whether you're visual, whether you like to listen, whether you like a mix of things, you can get to our content. The other thing we do is we do something we call perspectives every month. And there's usually a public-facing and a members-only part of that. And Simon asked us a question, and it's a lot like what we're doing today, where all of us have a different answer to that question, where we say, oh, and sometimes I really have to think about how I would answer the question, because it's not necessarily a question I've ever thought about. Not always, but that's happened a couple of times. And it really causes you to go, oh, wait, here's how I'm actually doing this. So as a member, I think it's fair to say you could spend an hour on our content every day. And I don't think that's true pretty much any place else. The amount of writing we do, the amount of content, and a lot of it isn't because Simon makes us. It's because we want to. I have like 3 things I want to write, and there's no rule saying I have to write them, but it's like, oh no, this happened. There have been days I got up and thinking, my day's open. I'm just going to read reports and do research and prepare tomorrow's show. And then it's like, oh, wait a minute, these 5 things happen. I'm going to write 10,000 words. We have the freedom to do that, and that is really, really exciting. We'll get to a couple more comments in a minute. I just want to go here to sort of my last question here. There's a couple more on the sheet, but we've sort of covered them. So I'm just going to go to one more. And the question is, are there any red flags that for you are always something that causes you to walk away? I would say for me, it's when a company consistently mentions something in a quarterly earnings report and then never mentions it again. Even when things don't go well, if a company says, this is our problem, this is how we're fixing it, and the next quarter they go, oh God, the way we wanted to fix it, yeah, that was a disaster. Here's what we're going to try. That to me is an honest company, because things are going to go wrong. But when the company just doesn't mention it, or this happens a lot in retail, oh, wow, our women's apparel was trending up at the first 2 weeks of the quarter, and then they don't tell you in the next earnings call how it came out, that to me is a very big red flag. I'll try to figure out to go to all of you. We'll start with Max just to shake things up.
Yeah, that's actually a really good point. And what you just brought up with companies that mention things and then never bring it back. One thing I see a lot right now in synthetic biology, which is an emerging area for investors, is there's a lot of financial shenanigans going on. There kind of always has been, right? When you have an industrial biotech process or research and development expenses, there's different ways you can like hide or move around the numbers and costs and make the numbers look a little bit better. And so far, most of the companies in this space kind of do that, right? We just saw a big short report that had a lot of truth to it for Ginkgo Bioworks. We've seen the similar things with Amyris. They've had SEC investigations. They've had to restate multiple years of financial filings, and they're currently actually hiding certain manufacturing costs in certain parts of their income statements and balance sheets. So I always really read through the SEC filings. And, if you understand how to read the balance sheet, how to read the income statement, how to read the cash flow statements, you can identify when things don't really add up, especially relative to what the company's saying publicly.
Steve Simonton, I'll let you take this one next.
Fraud. That's something that's a big red flag for me, is when a business has been caught for those things, or and even in some cases accused, and you think it's reasonably you're reasonably confident that the accusations could actually hold water. But it's really tough for me. There's been businesses out there that have been caught in fraud. Your Luckin Coffees, right? Where people come back and they still continue to invest in this business and say, well, they got caught and now it's okay. It's all fine. But like, I do not trust. It takes a lot to earn back my trust if companies actually get caught.
And I think largely with Luckin Coffee, people are saying the share price went so low, there's no reason to sell it because it might recover, and it has to a point. So sometimes you own something and it just tanks so badly, there's almost no reason to sell it because, but Steve, what do you do if a company has fraud, but then fully replaces its management? Because that would actually be the case at Luckin Coffee. None of the people involved are still there.
It's going to be a while before I'll even touch it. Right. I have no problem cutting ties with businesses like that. I say, nope, It's hard to tell, how deep sometimes those things go. But fraud and really consistent dishonesty, right? You see some management teams get caught in those kind of smaller, they consider your white lies. That's tough for me. But that's something I definitely try and keep in mind as we're looking through. Those are things that are big red flags.
Matt Cochran, you actually worked in fraud. That, of course, is preventing it, not committing it. Is that an area for you? What is your red flag? What are some of the red flags you look at when making an investment choice?
Well, yeah, no, I mean, I think fraud would rank there. Like, I don't think there's any investor who would see fraud in a company and be like, that's all right, don't worry about it. But besides something like outrageous like fraud, you don't want to see, like, if I invest in a company that I believe has an economic moat, and that economic moat starts eroding, whether that could be from a disruptor or a better product or better service, or just like a problem with their own service that why people are leaving, that should make you like pause. So you can take a tech company like Oracle and their on-site servers that they have proven immensely sticky with so many customers, and they're still growing revenue from those. And yet you see the cloud growing at a much faster rate, and people, new companies starting out, like they're not going to Oracle and saying we need servers. They're going to AWS or Microsoft or Google Cloud saying we want to use those products. So just when you start seeing an economic moat eroding, I think that's a red flag.
Economic moats and real ones. If you start to see the sharks and alligators dying, that is also a concern. Simon, last word on this before we move to a couple of comments and then hit our finisher.
Oh, transparency, Dan. How about the next door neighbor of fraud, which of course you should tuck tail and run if you see any company that's committing fraud out there. But the transparency is, a lot of companies are kind of hiding some skeletons in their closet, right? And a lot of it is just the way that they're paying their management teams. I mean, this is where you got to do a little bit more digging. You can always look through the definitive proxy statement to see how executive compensation is structured. But there's just sometimes great companies, great market opportunity, great technology. They're taking all the money out of the business and giving it to their own pockets. And if you see something like that as an absolute red flag. Nuanced Communications, perfect example of this, doing natural language processing. They were doing the dragon dictation for surgeons. When they were doing medical procedures, they wanted to talk rather than write down what they were doing. So it was a perfect fit for this. But oh my goodness, Nuance's executive compensation plan was egregious, capital E, with how much money their executives were taking home for not really even doing anything. The metrics were so low, the bar was so low on what they had, that Nuance had less than 10% of shareholders approve the executive compensation plan. I've never seen that bad before. That's absolutely egregious. That's terrible. That's no good for you as an investor when all the money that a company's making is just going to the pockets of their executive team.
You want to see executives make a lot of money, but you want to see it based on incentives. I have never cared if you say to me, my stock is now worth 100 times and the whole executive team are now, tens of millionaires. Well, that's great because we all won. But you do have to be careful when sometimes a really good idea becomes a bit of an employment scam where the goal is just kind of to bleed the company. That scares me with some of the, let's call them lesser SPACs, the ones where there's just, really anything in the media space, from like a bunch of print magazines are getting together and going public. It's like, ooh, like I don't know that you're seeing that money back. And I'm sorry to pick on those companies, and maybe there will be good ones in that space, but I don't usually love to go to the same person. But Max Lucas asked a really good question. So we're gonna go to Max and then to Mike, and we'll limit it to one or two people talking. But Max says, do you think management, sorry about that, JT. Do you think management depends more on the business and industry too? I don't know who Walmart's CEO is, but I'm pretty sure that company is close to just running on autopilot.
I think he means waste management, by the way.
Oh,
yeah.
Damn it, that defeats my entire property. So
you can take it with Walmart, Dan. You can use a news ticker.
Walmart works too.
Which is WMT, of course. I thought he was abbreviated. I don't think in tickers. I think in company names, but I think it actually works for both of them. That could be true, but you don't know what's happening behind the scenes. And I'll give the Walmart example. The CEO of Walmart, whose name is escaping me, Matt, I'm sure you know it, he empowered Mark Lowry to build their whole digital business. And to do that, he had to basically take power away from people who'd been there forever. And it was very difficult. You don't know if at Waste Management, where they're moving into more of a sustainable world, more of a recycling world, if that CEO, it seems like autopilot, but he's actually engineering a pretty big change in the company. I could be wrong, but sometimes that is something to look for. Simon, I'll let you weigh in on this one, and then we'll jump into Mike's question.
Well, just, I mean, from the waste management perspective too, I mean, waste management is not, it's a business that is going to run itself to some degree. I mean, you've got to go out there and make acquisitions, of trash routes and, recycling and all the opportunities that are out there. But this is very different than being a super innovative Elon Musk visionary kind of CEO. I mean, different types of companies need different types of leadership teams, and they need to make different capital allocation decisions. If you saw Waste Management tomorrow just plowing all of their money into multi-billion-dollar acquisitions, that they were going to do space internet or something crazy, then you should run away and turn from that kind of investment. It's totally out of touch with what the company should be doing. So, whether it's an innovative CEO, whether it is a CEO that's managing the operations of the business, whether it's a CEO that knows how to do M&A, there's different needs for different kinds of companies. Find the one that fits you as an investor.
Yeah, and even the most old line company needs to evolve. Waste Management of 1985 looks nothing like Waste Management now. That world has changed. They're no longer just like dumping your trash into landfills. They're a technology company in very, very strange ways. So I actually think being a skilled operator works in a lot of spaces. And I joked the other day with the Nearbon that if something happened to Elon Musk, that John Legere, the former CEO of T-Mobile, could take over. And he disagreed. I'll be fair to say that. But I think if you're really good at operating, you can figure it out and you can operate. I want to take Mike Fee's question, which we'll close out with. We had another piece, but let's round the show with this because I want to get kind of everybody's opinion here. Look for companies that have independent majority on the board of directors. Also, I'm a bit hesitant when I see the CEO of a business is also the president, chairman of the board, etc. This does not bother me. I think there are some benefits when you have an independent chairman or some board members, but the vast majority of publicly traded companies tend to have power concentrated in one person. A strong board is important, but I'm not so sure I agree on this one. Steve, your thoughts here?
I'm not that hesitant. When I see a president who's also CEO, I think for me, that speaks to, some founder-led companies. You have a CEO who's also chairman of the board or something. So I don't think that's as much hesitation for me. No.
Yeah, titles are just titles. It's, Simon could call himself Lord Emperor of Seven Investing, but if he listens to Steve, if he listens to us, it doesn't matter. And I think a lot of places people get hung up on, they'll have 17 titles. Disney has often been a case where people have had all the titles, but they also have a really strong board and a relatively short leash, even though they've had long-term CEOs. Matt, do you have any thoughts on this one?
No, it depends so much on the company. So I wouldn't make that a rule. It's something to note, to make a note of, but it really depends so much on the company. I'm invested in a lot of tech companies where there's different shares and the founding CEO has it doesn't matter what the other shareholders vote for because the shareholder rights as far as voting goes are almost non-existent. But if I think the company has a great moat and I think the company CEO, the founders did that to protect their voting interest in the company, then I'm okay with it. I just think it depends so much. I wouldn't make a rule out of it. Something to note, something to realize, but that's it.
So, Steve, we have had our friend D call for you to take a Ricola. Steve, a little bit under the weather, has braved through the show today. I was going to close there, but let's bring up Mike's comment. Let him follow up a comment on his own thing. And he said, everyone should read Dear Chairman by Jeff Graham, and it might change your perspective. Thank you for the reading. And Simon, I thought you might want to comment on Karen's comment. I know there's some legal wherewithal, because I would say, dear God, start with us. We have the broad interest of individual investors, not specifically, can't be specific, but broadly. But Simon, why don't you thread the legal needle of this question?
Karen, first of all, thank you, Karen, so much for asking this question. This is a safe environment we always want to create for people to ask questions exactly like this one. I'm so thankful that you're speaking up and asking a question about investing like this. Your question is, for anyone listening in, who best teaches a beginning investor how to actually buy individual stocks and navigate brokerage and retirement accounts? Stupid question. I do not think this is a stupid question, by the way, but you say, is this what the stockbroker or financial planner does? Right. So a financial planner's job is to kind of be more personalized, to help you figure out your retirement goals, what you should be investing in, how much should be in stocks versus bonds, what's the value of your home, of the other assets, what planning do you have for your children to go to college, for anything else that's going on in your life. That's where something like a financial planner is extremely valuable. A stockbroker has changed in definition in recent years as we've had discount brokerages where people can buy stocks themselves. In fact, today, most brokerages, Fidelity, whether you're using Schwab, whatever it is that you're using out there, even the newer ones are zero fee brokerages, which means you can now go out and buy stocks by yourself for no fees at all if you know what you want to buy and how many shares of them you do. There's still brokers out there too that if you want a little bit more hand-holding, a little bit less experienced in doing that, they can certainly do that for you for higher fees. But for the most part, what we try to do with 7 Investing is do the research of saying, okay, do you kind of know what you want to look for? Do you want to go after a really risky company that might have more upside potential, but there's also downside because of the risks? Or do you want something that's really, really stable that you can really sleep well at night, every single night, because it's ironclad and it's paying out dividend income for you every quarter? And then we kind of hand it off to you to, like your question it implies, of what do we do with this? If you have a brokerage account set up, you have a Fidelity account today, and you say, I really like Max's pick that he recommended for 7 Investing in October. Now you can take the next step and say, I'm going to dip a toe in the water and buy some shares. And now I'm going to probably follow this company a lot more closely because I have a small stake in it personally. That's what we're trying to empower with 7 Investing. And as you get more and more comfortable with this and kind of look at more and more things, become more experienced as an investor, it's going to open your eyes to kind of this long-term journey that we're really trying to create. Thank you so much, Karen, for the question. Info@7 Investing. If you have further questions, I will personally respond to them.
Yeah, and it is important to know there's a lot of content on our site about this. How many stocks should I own? There's no one rule, but it's a question we've all answered. How do I buy a stock is something we've covered in our new members call. So if you haven't been to one of our new members calls and you're a member, it's really worth listening to that, because we go through how do I set up a brokerage? How do I pick one? And we don't tell you which brokerage, we take you through how we do it. I know I'm going to write something in the next couple of weeks about setting up a custodial account, which is something a lot of parents have to do. So all of that information, our different styles, is all there. And again, we're not a financial planner. We're not giving you that specific advice, but we can all tell you, this is what I do. And you can say, you know what, geez, my situation's a lot like Dan. I really like what he has to say, but I'm a lot more interested in what Steve's investing in. You can take from here, take from there. We think we give you the full buffet, including the guy who's making an omelet and the guy who's carving at least rack of lamb and prime rib. There might be some salmon as well if it is a holiday. With that, I thought this was going to be a half-hour show. This is a really informative show. I'm really happy we did this. Simon and I are going to be back on Monday, and we are going to be talking about why valuation matters for tech stocks. We had planned to do this 2 weeks ago, and Facebook broke, and that caused everything to go kablooey. So we have a very planned show that we are going to do. It takes a lot of people behind the scenes to make this happen. Well, not a lot. It takes JT and Sam. JT Street, who directs this show, helps us put things together, always has great ideas. Sam Bailey does the scheduling, is our director of marketing, does all sorts of things. We wish Anirban and Dana were here with us. We understand why they're not. We just like to see them. But for Steve, for Max, for Simon, for Matt, for JT, for Sam, for everyone in the 7 Investing family, I am Dan Klein. We will see you on Monday.